If you're tired of jumping from one strategy to another and still not getting consistent results, this video is exactly what you need. This isn't just another theory. It's a step-by-step framework designed to help you trade with structure, clarity, and confidence. Welcome back, traders, to the ComLucro channel. This lesson is part of our Smart Money Concepts course, and in this chapter, we'll focus on discount and premium zones. You'll learn how to analyze price action through the lens of smart money concepts, how to identify discount and premium ranges using Fibonacci retracement, and how to define precise entry and exit points for high probability setups. By the end, you'll have a clear and repeatable roadmap. No more guesswork, no more confusion, just a focused plan to guide every trade you take. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's start with the basics. The market always moves in impulsive and corrective waves. This fractal nature of the market is driven by the behavior of market participants. When sentiment is bullish and traders are optimistic about an asset, they tend to buy, resulting in an impulsive move in one direction. However, as the price rises, some traders might feel that the asset is becoming overvalued and decide to take profits. Others might go short, which can trigger a pullback or correction. Conversely, when market sentiment is bearish and traders are pessimistic about an asset, they tend to sell, leading to an impulsive move in the opposite direction. As the price falls, some traders may start to feel that the asset is becoming oversold and decide to buy it back, which can again trigger a retracement. Impulsive waves often push the price a greater distance with momentum, characterized by same-color candles with large bodies. In contrast, corrections represent indecision on the chart, marked by mixed-color candles with small bodies and sideways wicks. Identifying the end of a pullback and the start of an impulsive move can be highly profitable, as it enables traders to capitalize on potential buying or selling opportunities in the market. Imagine we're in an uptrend and want to buy low and sell high to benefit from this bull market. We cannot open a buy position right now because the price is too high and may drop at any moment. So we need to wait for a correction to enter at a better price. The latest impulsive move has started from here and pushed higher all the way up to here. The correction will happen inside this range, and when the market gathers enough liquidity and buyers come into play, it will continue pushing higher again. If the price breaks below this level, it shows that the buyers are no longer in control, and the whole idea of an uptrend comes into question. This indicates significant bearish momentum and signals a possible reversal, unless it was a fake-out where the market aimed to gather liquidity below this low before taking off again. Now, back to our correction range. Here's the question. Where should we place our long position and enter the market? If we enter too early, the price might make a deeper pullback and we end up losing, even though our analysis was correct. On the other hand, if we wait too long, the price might start pushing higher without us entering and we miss the trade. So the whole idea of trading with the dominant trend is to identify the end of the correction, which is the start of the next impulsive movement. But how are we supposed to do that? This is where Fibonacci retracement levels come into play. We always apply this tool from the start of the impulsive wave to the end because it helps us identify the correction range. If you apply this tool, you'll notice that a series of levels appear on the chart. All of these key levels will act as support and resist the price when it reaches them. As it goes lower, it indicates a deeper retracement. But for now, we only need the 50% retracement level. The area above the 50% retracement level is called the premium side of the range, and the area below is called the discount zone. The 50% level itself is called the equilibrium level. When the market sentiment is bullish and we have an uptrend, we want to buy in the discount zone for multiple reasons. 1. Safer entry. The market tends to take out early buyers and use them as liquidity for future movements. So waiting for the price to enter the discount zone and then looking for signals to go long will instantly increase our win rate. Of course, every strategy has its downsides. In this case, we might miss some trades due to conservative trading, but a missed trade is always better than a losing one. 2. Higher risk to reward ratio. We know that regardless of our entry point, the first target for the trade is this recent level of market structure. When the price reaches this level, some traders will close their positions or take profits, while others might go long. This can create a correction or even reverse the direction, so this level will be our first target. If you enter in the discount zone, our risk to reward ratio would be too low. We always want our trade to have more than a 1-to-1 risk to reward ratio. That's why trading inside the discount zone will give us a higher risk to reward ratio and a more rational trade. 3. Safer stop. The optimal price level to set our stop loss, ensuring safety from market fluctuations, is below this swing low. If the price breaks through this level, we will experience a market structure shift. Therefore, the bulls will do their best to support this level. Hence, the closer your stop is to this level, the safer it is. This is the third reason why we enter trades in the discount zone. Now, let's have a recap. In the bearish scenario, imagine we are in a downtrend and want to sell high and buy low to benefit from this bear market. Right now, we need to wait for a correction to enter at a better price. The latest impulsive move started from here and pushed lower all the way to here. The correction will happen in this range. And when the market gathers enough liquidity and sellers come into play, it will continue pushing lower again. So we will apply the Fibonacci retracement tool and define the discount and premium zones. When the market sentiment is bearish and we have a downtrend, we want to sell inside the premium zone. Here's an important point. The impulsive moves can happen on a larger scale. For instance, consider this market structure. In the 1-hour time frame, we have 2 turning points for the price. The market was in a short-term uptrend, then a downtrend, and then an uptrend again. But if we look at the higher time frame, these 3 structures are considered a single movement. So if we apply the Fibonacci retracement to the latest impulsive wave, we would have our discount and premium zones like this. Therefore, there is a higher chance for the price to enter the discount zone and then witness a reversal. Now let me show you how to combine this with smart money concepts. Consider this structure as our higher time frame. When a change of character in the lower time frame appears, it signals a possible reversal. If the price contains enough liquidity and bullish momentum, the price will start pushing upwards. Otherwise, the price will continue to fall. This scenario may happen multiple times until the price gathers enough liquidity and momentum. Then the price will take off and show us the movements we want to see. So, a more conservative way of trading is to look for changes of character inside the discount zone. The best way to predict whether we're going to have a small correction or a large one is by observing the previous market behavior. In strong trends, we usually have small pullbacks with significant momentum. Conversely, in trends with deep retracements, we expect a larger correction compared to strong markets. The same concept is valid with the optimal trading zones. In this example, if we look at the left-hand side, we can identify 3 fair value gap areas. When the price pulls back to these areas, they will act as support and push the price higher. But if we wanted to place a buy limit, these 2 would have been our choice. The difference between these 3 is that the higher one is located inside the premium side of the range, and the lower ones are inside the discount. We're only interested in buying inside the discount and selling inside the premium. This is a more conservative way to enter trades, resulting in a higher risk to reward ratio. It works best when the market is making deep retracements. But if we're witnessing an aggressive trend, buying in the premium side of the range can also be profitable. However, the important point here is that you're not going to win every single trade, even if you only take high-quality setups. Sometimes the market has different opinions. Even with a 30% win rate, you can be profitable as long as you have a solid risk management plan. You can't control the outcome of a single trade, but you can control the outcome with an overall good risk management plan. As long as you take high-quality setups and stick to your rules, you will be fine. But remember, before placing any trade with real money, you must do enough backtesting with your trading plan to obtain the performance and confidence needed to trade. Now, let's look at some real chart examples and combine all the concepts we've discussed. Here we have the pound-dollar on the 4-hour chart. There is a clear downtrend, and this is our recent bearish impulsive movement. Let's use the retracement tool to identify the premium and discount zones for the recent impulsive wave. One thing to remember about live trading is that waves are always expanding, and we never know where the movement will end. So if the wave keeps expanding, we simply adjust the retracement tool accordingly. Now that we have identified the zones, do we have any fair value gap and optimal trading area? If we look at the left-hand side, we can mark this gap between the candles. Since this is a very tiny zone to look for rejections, let's also mark the candle that created this fair value gap as our order block. This box is considered our optimal trading area, located inside the premium side of the range. The idea is to wait for the price to enter this zone. Look for a change of character in the lower time frames to confirm the reversal, and then go short. Another confirmation for this setup would be for the market to create equal highs, then sweep the liquidity above them and show a change of character. So first, we wait for the price to enter our optimal trading area, then zoom into a lower time frame, which is the 1-hour chart, and observe the price action. Here on the 1-hour chart, we are looking for a price action signal indicating that this short-term uptrend is over and that the price can continue to push lower in the higher time frame direction. So what do we have right now? We have a liquidity sweep pattern above these equal highs, which is an early reversal signal. It shows that this break was nothing more than a fake out and a liquidity run above these equal highs. Now that the price has collected the liquidity, it can continue pushing downward. This signal is later confirmed by breaking below this low, which is considered a change of character. Keep in mind that all of these signals have occurred inside the optimal trading area that we marked on the higher time frame. So the whole price action in the 1-hour chart suggests a market structure shift, and now it's time to place our short entry. But the question is, where should we place our order? Usually in this case, we would look for fair value gaps and order blocks, but in the latest move, we do not have any imbalance in this time frame. So we can either apply the retracement tool and place our sell limit order at the beginning of the premium area, or we can zoom into a lower time frame to refine our entry point. Let's zoom into the 15-minute chart. In this time frame, we can see that we have an unmitigated fair value gap area near the swing high. If the price returns to this area, it would act as resistance and push the price downward. So let's open a short position, a spread size below the fair value gap, and set our stop above the swing high. Our first target would be this low. For a long-term target, we can track our profits until we reach the next important level in front of the price. This is how to apply the trailing technique correctly. Every time the price breaks below a level of market structure, we reposition our stop above the previous swing high to secure the profit. For example, take this green line as our stop loss. Right now, our stop is here, but every time the market breaks below a swing low, we would reposition our stop loss above the previous swing high. This way, if the price decides to change direction and hit our stop, our winning trade would not turn into a losing one. And since we have secured our profits, we can let the profits run without any mental pressure. In conclusion, mastering the concepts of discount and premium ranges, along with understanding market structure and using tools like Fibonacci retracement, can significantly strengthen your trading strategy. By combining these methods with smart money concepts and solid risk management, traders can greatly improve their consistency and long-term results. Always remember to backtest your approach, and above all, maintain emotional discipline. Because in the end, mindset determines everything. And that's exactly why we created the ComLucro Trading Psychology course, to help you build the mental framework that supports your technical edge. Up next, we'll play a short clip from one of its most powerful lessons, Emotional management in trading. Now, let's start with something simple but real. Losses hurt, not just financially, but emotionally. When you lose money, it is not only your account that takes a hit, it is your identity as a trader. You start to question yourself. Did I do something stupid? Am I really cut out for this? That self-doubt is where emotional damage begins. Psychologists have shown that losing money activates the same areas of the brain as physical pain. That is why you do not just see a red trade, you feel it. It is a punch to your confidence. And when the pain of that loss stays unresolved, it does not just affect one trade, it infects the next ones too. That's why professionals treat emotional pain seriously. They know the real damage does not come from the loss itself, but from the emotion left unresolved. One unprocessed loss can lead to weeks of hesitation, revenge trades, or impulsive decisions. So if you found this lesson valuable, make sure to watch the full video, Emotional Management in Trading, and explore the entire trading psychology course here on the ComLucro channel. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.